Hello everyone, how are you? Hope you've gone through the lecture on balance sheet and now you are ready to start with the next topic that we have on hand, which is income statement. So I've put a sample income statement on my screen for you all to have a look. And I'm sure that you already have gone through income statement. You might have also prepared income statement during your graduation or maybe even your post-graduation. So the idea from an examination perspective is, right, let's also understand how this concept can be tested. What is it exactly that you should be understanding when you look into income statement? Now, from an examination perspective, there is a chance that you get income statement. And how is it that it can be tested? It can be tested in simulations. So what can happen in simulations is they can give you certain line items, and for the remaining line items, they can give you information to calculate or arrive at that figure, right? So it's not that 100% from scratch income statement you are required to calculate or create, but bits and pieces, right? Maybe, some information, let's say, would be asked for you to prepare basis the exhibits or extra information that is being given to you. So certain documentation which are attached along with a simulation, we call that as exhibits. So they might contain, let's say, information to calculate depreciation or maybe cost of goods sold, etc., etc. So basis how the simulation is created, you can expect an income statement, right? And when we look into MCQs, you can expect, standalone MCQs, which might ask you to calculate, let's say, for example, what is cost of goods sold, what is the total selling expenses in the given year, or what is the income tax expense for the given year. So such questions, independent, can be tested in the examination, right? We cannot rule out the possibility, but the possibility of you being required to create an income statement from start to finish is not there, right? So they cannot ask you to create that. Now, as you can look into this income statement, we start from gross sales, right? As you would do for even an Ind AS based income statement, right? We start from gross sales. To that we add or deduct any additional income or any additional revenues, etc. And here we have deducted any sales discounts, returns, etc., which gives us net sales. Right, from that obviously we'll deduct cost of goods sold, which will give us gross profit, selling expenses, and then we move on to general expenses. So these are known as SG&A expenses, selling, general and administrative expenses. Right, most of the times they are classified as non-operating expense. Right, operating expenses are expenses which are with regards to production, right? Let's say cost of goods sold, etc. These are production related expenses and we call them as operating expenses. Expenses which are not related to production, we call them as non-operating expenses, right? When we deduct that, we get income from operations. Now, this is a unique line item which you would find in GAAP. You will not find this in Indian accounting or Ind AS. So the idea is that in case a company has decided that, hey, let's say, for example, we are talking about a biscuit manufacturing company, let's say about Britannia. So Britannia, a couple of years down the line, it decided to discontinue the manufacturing plant it has in West Bengal, right? And maybe it would want to shift it somewhere else, etc. That's futuristic. But when we talk about the discontinued operations, or what is the difference between income from operations and why are we presenting such a line item? The idea is for the companies which have a discontinued operations, not for each organization, but in case in a particular year a company decides that, hey, let's say A to C, these verticals I will continue to have, but the vertical D I will not have, or discontinued operations. Only in those years we will have a separate line item for discontinued operations, right? That's why here we are calling it as income from operations. That indicates that there might be a income from discontinued operation. In the sample we don't have, but technically when you have income from operations, when you're specifically calling it out, you need to have a income from discontinued operations as well, right? Then we have other revenues and gains. In case the company has invested in stocks and bonds of other companies, it has certain revenues or gains, profits which it has made from those investment will be parked under other revenues and gains line item. To this we will deduct any losses also, right? That gives us income from operations and or income before taxes. From that we deduct income tax expense, which gives us net income. Now, as per SEC, Securities and Exchange Commission, the EPS per share also has to be presented. So you see, a EPS per share is presented 37,000 or $37.5, right? This is simply calculated by dividing net income by number of shares, which is 20,000. So 750 divided by 20,000 shares gives us $37.5 of EPS, earnings per share, right? Now this is a sample indication, sample format of an income statement. Now let's deep dive into the income statement. Let's understand what are the unique nuances of an income statement for GAAP, right? Now, when we start discussing an income statement, we first have to understand that what we are doing is we are working in this category. We are just working into temporary accounts which are usually created at the beginning of the year and closed at the end of the year. Let's say sales or revenue, right? Net revenue is a yearly figure which is created every year, which account is created every year and closed by the end of the year, right? So all these temporary accounts are reported on the income statement. At the end of the year, they are closed to balance sheet under retained earnings. So if I have to show you this is how an income statement looks like. This is how the balance sheet looks like, which we had seen in the last lecture. Now this net income figure, which we arrive, as we have seen in the last example, this moves on to retained earnings, which is a component of equity in the balance sheet, right? So net income on a yearly basis gets added to retained earnings and any dividend distribution is done from here, right? So many of times the questions will test you for this understanding that which journal entry is passed when dividend is declared, right? So we know that the dividend is declared from retained earnings. So it impacts a dividend declaration impacts retained earning, does not impact net income, right? So this is a clarity you need to have even for yourself, but otherwise from examination perspective as well, right? Now anything which is permanent, all the permanent account, they are always parked in the balance sheet. Let's say you have current assets, let's say you have plant, property and equipment, right? They are all permanent or real accounts which are there after on a year-on-year basis. Whereas income statement items or accounts are created yearly and closed at the end of the year, right? This is the equation for an income statement, right? We saw an equation for balance sheet in the last lecture, which was asset equals to liability plus equity. Now here for the income statement, the equation is revenue minus expense plus gains minus losses gives you net income. So this is your equation to understand net income, right? Now as I said, discontinued operations are presented in an income statement in the year in which the company decides that, hey, this is one segment, this is one vertical, or this is one asset which I don't want to continue either using it or making business from that, or doing business from that particular vertical. So under both these conditions, you will have a discontinued operation in the income statement, and only in those years you present one line item which separately identifies continued operations or income from continued operations, right? Now, in case you have any questions about the topics that we are discussing, please feel free to drop a comment in the video, in the YouTube video, and I'll get back to you, right? I will try and cover as much as I can, but still if anything is missing and you have a question, feel free to reach out to us and we will respond back. Okay. Now moving on to the components of net income, what's included and what's not included there. Right? So if you look at this, transactions with owners, right? Something I just called out, dividends, stock issuance, all these transactions are not presented on the income statement. Error corrections, all the error corrections are impacting retained earnings. It will never impact net income, right? When we get on to that topic, we will discuss how a net income or how a error correction is done in a retained earnings. How does it impact and everything? How does a retained earning gets impacted? How does asset gets impacted? How does liability gets impacted for either error correction or any changes, accounting principle change, etc. So this discussion we'll have at a later point of time, but let's understand that error correction never impacts the net income. It always impacts the retained earnings. Okay. Then items reported in OCI. We will discuss what is OCI, which is something which is a part of statement of comprehensive income. And as I had discussed in the lecture earlier, the statement of comprehensive income includes net income calculation and these OCI line items. So when we adjust OCI items, which are other comprehensive income, with net income, we arrive at comprehensive income. Right? So these OCI line items are not presented in net income calculation. They are presented as a separate component. Right? Then transfers to or from appropriated retained earnings. As we said, retained earnings adjustments are done with retained earnings, never impacts the net income calculation, right? It does not impact the net income calculation. Then we have effects of accounting changes on prior periods. As I said, let's say for example, the company has changed its inventory method from LIFO to FIFO. There would be an overall change in the inventory valuation. There would be an overall change in the income and eventually the retained earnings. So we don't calculate or impact the net income with a change in error correction or for that matter accounting changes. We do the final impact, final change in retained earnings, right? As we progress, we will discuss these aspects in other chapters. Right? Now moving on to the COGS. So what we will do is one by one we will cover the line items that we have in the income statement. So revenue is something which we all are aware, that the total sales of the company plus any other allied sales, right? So what is the difference between revenue and sales is that sales include any other allied items. So if I have to give you an example, let's say that we talk about Walmart. Right? Walmart sales would be, or for that matter, lifestyle or any other, West Side or any other chain, right? The revenue of, let's say, West Side will include the overall sales which West Side has done. And this is a net sales figure. So any returns, any discounts we have deducted already. And here we are saying any allied items. What do we mean by allied item? Let's say that when you purchase 5,000 INR worth of goods in one go, you receive membership. Right? So similarly, all the companies, they give these kind of allied services, which is not really their main business, but it generates revenue for them. So revenue includes net sales plus any such income generation from, let's say, membership points, bonus and all that stuff. So you collect 100 points, you get 100 rupees of discount, etc. Right? So there is some kind of a revenue which is being generated for the company when they give you such kind of offers and discounts, such kind of memberships. So these are allied service line, product line, which is not the main business of the company. They are included in sales to make revenue. Right? That's the revenue figure that we have. Now from that revenue, we are going to deduct cost of goods sold. Right? And what is cost of goods sold? So cost of goods sold for a retailer is pretty easy and simple. What we have is opening inventory. To that opening inventory, we add any purchases that we have made. So we have opening inventory plus purchases. That gives us cost of goods available for sale. This is known as cost of goods available for sale. When we deduct ending inventory from here, we arrive at cost of goods sold. Right? Very easy, plain and simple for a retailer. Now when we move on to cost of goods manufactured, for a manufacturing company, we start with beginning WIP. To that we add periodic manufacturing cost, whatever are the cost incurred for that particular month, quarter or year, that we add. From that we deduct ending WIP, which gives us costs of goods manufactured. Now to this cost of goods manufactured, when we adjust for opening finished goods and when we deduct closing finished goods, we arrive at cost of goods sold. Right? So this gives us COGS for a manufacturing organization. The difference between COGS and COGM is the opening and closing inventory. Now, similarly to this cost of goods available for sale, here also to cost of goods manufactured, if we just add beginning finished goods inventory, we arrive at cost of goods available for sale. Right? From that, when we deduct closing finished goods inventory, we arrive at cost of goods sold. Right? Do look out for this term. This is at times presented in a question, and till the time you don't know that this is the difference between COGM and COGAFS, you might not be able to solve your question. Moving on, let's discuss selling general and administrative expenses, popularly known as SG&A, right? So these are popularly known as SG&A expenses, and in a upcoming lecture, I will take up a live balance sheet income statement, or you could say live financials of a listed company, and I will do a deep dive of all the line items and all the financial statements which are presented. So there you will see that you have a dedicated line item which is SG&A, selling general and administrative expenses. So needless to say, these are all selling expenses, commissions, salaries, etc. of sales team. Sales department, rent, salaries, depreciation, right? In case the sales department is using any kind of machinery, mostly laptops these days we use, right? So all that depreciation which is for the assets used by sales department would be separately depreciated. Then you have any internet cost, etc., Wi-Fi cost, any shipping, freight out cost, if at all there are any. Then advertising, right? Any brand building exercises, any advertising expenses which the company does would be a part of selling expenses. Moving on to general and administrative expenses, any accounting, legal, professional fees, etc. Accountants, any a legal department which the company has, all these will fall under general and administrative expenses. Office salaries, CEO salaries, CFO salaries, all these are part of G&A expenses. Insurance of the office building, wages of office staff, office supplies and occupancy cost, all these are G&A expenses. Most of the times you will see that this is one single line item. Now moving on to the presentation of an income statement. Now, as per GAAP has given couple of options to companies that, hey, you can present your income statement in this format, or this format, right? All these formats are acceptable. Nothing which I discuss now is something which is not allowed. But the idea is that in case, let's say the company is presenting a single step statement, right? Here what we have in a single step statement, we just have all the income in one go and all the expenses in one go. That is a single step income statement, single step format. So you have net sales, you have other revenues, you have other gains, which gives total gains and revenues. To that we deduct all the expenses in one shot. So you have COGS, you have general and administrative expenses, interest expense, losses, income tax expense. So all the income in one go, all the expenses in one go. This is an allowed format of creating income statement. But the idea is that when you are presenting the notes to the financials, right? We have discussed in the last lecture what are notes to the financials. Whichever format the company is using, a in-depth discussion or presentation of how these line items are calculated is presented. What are the major accounting policies of the company, right? A lot of things which are not presented on the face of financials are discussed in notes to the financials. So any information, in case you want to get to know more about how you arrived at this figure, you should pick up the notes to the financial to get to know why and how, right? Now, the other two formats are multi-step and condensed income statement, right? Let's look into how these are differing. Now, the first income statement which I had presented when we started the lecture is a multi-step income statement. So you have all the line items separately presented. Let's say operating, not non-operating. You have gross profit. From that you will deduct, gross profit is presented from, and then you'll have income from operations which is presented. So there is a multiple step presentation which is done, whereas in the condensed format it only shows section totals of the multi-step format. So that means you will not find the overall calculation of net income, you will not find the overall calculation of COGS, but rather you will just find the final line items here. And disclosure of how you arrived at these line items are presented in the notes to the financials. This is again something pretty popular in the US to present, because you are able to show all the line items just like this, and you are not confusing the user with a lot of information, right? How they arrived at net sales and how they arrived at COGS. You're not showing them that calculation, you are showing them everything in one bulleted format. In case you want to know more about it, refer the notes to the financials. Again, this is something we had seen. This is a multi-step income statement. Okay, let's look at a quick knowledge check question. Which income statement format shows only the section totals of the multi-step format, right? This is something we just discussed. It is a condensed one which shows the section total. So it's not a single step, it's not a comprehensive one, it's not a consolidated one. So there is no, by the way, there is no comprehensive and no consolidated format. We have single step, multi-step and condensed formats, right? And this is what the examination will do. Though this is a very simple question, right? This is not a twisted question, but the idea is when I take this question is for you to understand that, hey, at that examination, you will come across certain terms which you might not have heard of or which might not be relevant at all for the topic which we are discussing. But the questions, they throw these terms at you to confuse you, right? As in when you practice more, you will get to understand this aspect that you need to be very sure of the question and what answer it is. Because if you are not, then the MCQ will make sure to confuse you, right? Now, moving on to discontinued operations, right? What qualifies for discontinued operation? So, as I discussed, in case a company has, let's say, 1, 2, 3, 4 business verticals, the company has decided, let's say we take the example of Britannia. Britannia has decided to discontinue its plant in West Bengal, this D, right? So now how do we present the operations of this? Let's say in 2025 March, Britannia decided that it will discontinue its D segment, right? So, and we are assuming that the financial year is January to December. Most of the US companies have a January to December calendar year or financial year, which is the calendar year, right? So, the financial year is January to December. The company decided to discontinue the operations in the month of March. Let's see how the accounting will have to be done. Right? So the criteria, the qualifying criteria is component of an entity, and the definition says that this should be rather differentiable from the other segments. It shouldn't be so integrated with the other segment that the accounting aspect of it cannot be segregated, right? It should be a standalone component of an entity that has been disposed of or qualified as held for sale. So either in, let's say March, let's say by October, company has disposed it off. In the month of March, the company decided, or let's say earmarked the segment for sale, and by October it has disposed it off. So either the segment should have been disposed of or it should have been held for sale. Let's say in the second scenario, this is the first scenario. Second scenario, no sale till December. Even in that case, we will still bifurcate the overall operations of this department D and present separately under income from discontinued operations, right? Now, how do you measure your overall income or overall loss, right? Most of the times you will find that there is not income but loss from discontinued operations, and that would be the major reason why the company is discontinuing the operations. Had the operation been very successful, had the product line or a particular plant been very successful and profit making for the company, mostly the company will not sell it, right? It will only sell when it's kind of making loss, and that's why you will find in most of the times, most of the discussions or questions that we take up, that here you will come across loss from discontinued operations, right? And what all loss is included, what types of losses are included? If held for sale, this second scenario, measured at the lower of carrying amount of fair value of the plant, machinery or department minus cost to sell. Let's say carrying value of that particular property is, let's say, because we are taking this division D, let's say the carrying value of that plant was around $200,000. Right? Since we are doing CPA, we'll do all our calculations in dollars so that you are comfortable when you're solving the questions, right? Or fair value minus cost to sell. Let's say the fair value of that particular division in the market would have been $250,000, because if you go out in the market and sell, you might fetch more than what's your book value is carrying, minus cost to sell. Let's say for appraiser, for a financial appraiser, or maybe selling expenses, any commission, etc., which you had to give, let's say is around 25,000. Right? So the overall fair value minus cost to sell, also known as NRV, is around $225,000. Right? And it is measured at the lower, because right now we are going to sell the segment, will have to be, and as it is, accounting is being prudent, being more conservative, right? So even if the fair value or the NRV is 225, you will value it at the lower of fair value versus carrying value, which is 200,000. So the remaining, in case that here in this case it is 200,000, so you are not booking any loss. But let's assume that the book value, the fair NRV is 175,000. Right? Your carrying value is around 200,000. So you will obviously value it at 175. Now this difference which the book value is currently carrying of 200,000 vis-a-vis 175, in that circumstance this 25,000 would hit as a loss under income from discontinued operations. Here we will not do anything because carrying value is the lower number over here. As it is, the book value is currently 200,000. You will not book any additional loss. Operating result include income or loss for the entire reporting period. That means we said that the company classified it as available for sale or held for sale rather in the month of March, right? So all the income from operations for the department, for the division from January to March plus April to December, all this will go as discontinued operations, right? So it's not that just the fact that, hey, the company decided to discontinue the operations by the end of March, so only April to December loss will hit the income statement as discontinued operations. No, everything will hit the income statement as discontinued operations. Include any write down or loss recognized on initial classification. Let's say when the company decided that in the month of March we will reclassify this segment as held for sale. If in case the company recognized any loss, that loss will also be included. Any gain on loss or disposal, right? Again, let's say, here we have marked it as 175. Let's say this 175 eventually was sold for 150. Again, the company will book 25,000 loss on disposal. Right? These bracket figures indicate a minus figure, which is nothing but loss. Right? So this would be the fourth component of discontinued operations. Right? And that is how we will present the income from discontinued operations. So the starting point is income from continued operations before taxes, then we have income tax expense, and then income from continued operations. Right? From here we will include loss from operations of component. So here this $330,000 is loss from sale of a certain component, right? So a separate line item, we presented income from continued operations separately. From that we will have tax benefit. So because this is a loss, right? If the company earns income, it pays tax. If the company incurs loss, it will get a set off in future tax liabilities, and that is treated as an income tax benefit. So here the company had a tax or income loss of, or overall cut this. So in this case, the company had a loss of $330,000, which basically gave the company a tax benefit, right? So this is the tax benefit from loss of the sale of a component, right? This eventually gave us loss from discontinued operations, the net loss from discontinued operations, which is 330 minus 132, which is 198, and which helps us arrive at net income. Now let's deep dive into the loss calculation, which we are mentioning over there, this 330. How did we arrive at this 330? Right? So we have operating losses. Let's say in this example, we are assuming that from or the company decided to discontinue the segment on June 30. So January to June, we will have income, which will present separately, and then from July to December, we will present the income separately. So this is January to June, 130,000 loss the company had made. Then again operating losses July to October presented here, right? October, the company sold off that segment. Total operating loss $210,000. Write down to fair value less cost to sell. So there was a decline in the fair value of the company's assets. That demarcation or that decline we are presenting separately. Then gain on disposal. The company eventually sold this. So let's say this 150, we have not been given the total value. So there was a loss on revaluation of 150 and the company eventually sold the property at a 30,000 benefit, a 30,000 profit. Then total loss 330, which we carried forward there. Income tax benefit at the rate of 40%, right? So the company saved 40% tax on $330,000. Eventual loss from discontinued operations is 198,000. Let's look into a small MCQ now. A component classified as held for sale is measured at historical cost, fair value only, lower of carrying amount or fair value minus cost to sell, net realizable value plus a normal profit margin, right? So this is not correct, not at historical value, not at fair value only. So this is half the truth. This is also half the truth. And if you look at D, net realizable value, NRV, plus a normal profit margin, profit percentage. No, that's not possible at all. Accounting is pretty conservative. So we are not going to value anything which is already loss making most of the times and add a markup there. This is one of the methods of inventory valuation which is kind of presented here to confuse us. So what we are left with is lower of carrying value. So if you have to present it, lower of carrying value or fair value minus selling cost, or you can also call this NRV, net realizable value. So that's the value you realize when you sell it, right? So this is how you can also, kind of recollect this. If you kind of, create some markers for yourself, certain abbreviations for yourself, certain mnemonics for yourself, it's easy to remember number of things in the examination. So, it's either or lower of both of these, which would be the valuation for discontinued operation, right? As we see, this is the correct answer. This is all about net income calculation. In a separate lecture, we will discuss all about the components of OCI, other comprehensive income, and we will try and understand what are the components there, how does it impact the equity of a company.